Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Paris milling wheat and London UK feed wheat. I'll start with Paris milling wheat. I have repeatedly stated that the chief imperfection here is not the changeover gaps, which I could really do with not having them. No. It is how the March-based bullish Andrews pitchfork, this super acute March-based bullish Andrews pitchfork, which I first drew as a speculative bullish pattern, how it has been able not only to survive despite its super acute bullish angle of attack, but also to thrive. Am I getting a message across? Well, that thriving has stopped and the survival has also stopped. This past Tuesday, when a threat I had seen late last week became a reality of a big combined key reversal down and bearish engulfing pattern that broke the back of not only the bullish Andrews pitchfork, but closing well below the lower tine, currently 436.75, but also the significant 4-pointer uptrend created since mid-April. There had been a wingman to this bullish pitchfork. They will both be retired after this commentary. I suppose the most surprising thing, actually, I suppose it isn't that surprising, but what on the face of it is a lesser 61.8% Fibonacci line at 389.5, proved to be the low of this week and allowed the market to turn back up yesterday with a bullish outside day, and today try higher still. So a recent lesser fib held the market up, somewhat surprising, you may say, and I would usually agree with you. However, given the extraordinary sharp bullish angle of attack of this market and how I have always thought it was unsustainable, well, then I suppose it's not as big a surprise as initially thought. Anyway, just in case we have a repeat lower, the next significant support below is some way down, still some way down, at the 50% Fibonacci line of the March to May move at 374.75. Beyond that, we have the 50% Fibonacci line of the whole of the 2022 move at 348 even, and then the rising medium moving average, currently 333.25, and the lows of March between 311.75 and 315.75. Even down there, we are still in pullback territory, in theory at least. It's only when we start going below the rising long moving average, currently 302 even, that we must start to consider the bullish incentive expired and another force may be taking its place. Personally, if we see prices back within the congestion created by the January action of 258.5 to 288.5, well then, maybe I would really start to look to the downside. Again, otherwise, keep a wary eye lower, but a more studied attention to the March high of 424 and what the market does there should it manage to get up there. London UK feed wheat. A lot less to go on here compared to some of the other grain markets, but we can still see some interesting actions and one key pattern that was triggered and subsequently came to fruition last week before so dramatically exiting the stage. You see, the peak in late March was the start of the last major pattern we had here. I've repeatedly pointed this out since I first noticed it back then. We had a late March to late April ascending wedge pattern. Currently it's still there, well, it's not operational, but the numbers are at 333 even to 334 even. This pattern was not the best ascending wedge pattern that I've ever seen. Even now, it does look a bit, well, ropey, but it is a true pattern and it reached not only the primary target X in the 344 even area, but the harder to get secondary target X1 in the 353.60 area. The move up was swift, which is what you needed for such a pattern. You really did. And the targets achieved, which was interesting. But what became even more interesting was what the market did immediately after that. So if all this bullish energy spent, the market last week suddenly turned a shade bearish. And I use that phrase advisedly. See, the action of last week came ever so close to make it into a weekly key reversal down. The conditions were set by close of business Wednesday last week, and all it needed to happen, to make it happen, was a close last Friday at or under 335 even. That was all that was needed. Well, we closed at 336.5, a shade away from fully bearish, but enough to prove two things. Firstly, that there is some serious technical action going on in this market, And secondly, to give this market a shadow of potentially lower prices this week. I ended my commentary last week with the following words, and I quote, "Hence, it will be very interesting to see what will happen early next week as we have finished with this bullish pattern and ended this week with a lesser bearish pattern," end of quote. Well, that lesser bearish pattern caused a larger bear move this week as prices dropped every day, such that today we have seen prices push down through and close below the first significant level of support. And that's below. And that's the rising short medium moving average, currently at 319 3/4. Now the questions here are the same as in the other grains. Firstly, is this a pullback or the beginnings of a bear phase? And secondly, how far will the drop fall? Well, the answer to the first question is yes, it is still a pullback, but I would keep a wary eye on it. The answer to the second question is it depends. Sorry for being obtuse, but it does depend. Right now, all we have seen is a pullback that has punched down through the first significant line of support. There are other supports, notably the late March to early April congestion between 300 to 308 even. It is not a great support, but it is still there and contains what could be the interesting recent lesser 61.8% Fibonacci line of 301.90. Next is the lows in the 290 area. Then the Fibonacci congestion between 283.65 to 287.55, which has the important 50% Fibonacci line at 283.65. Then the congestion between 262.5 and 265.5, then 250.5, and then a band 239.25 to 245.15, which contains the rising long moving average, currently 243.35. This last one is ultra important, and one could only say that the bullish incentive has been extinguished and a bearish incentive has replaced it if that one is broken. There is one other significant dynamic support that needs consideration to all these, and that is the medium moving average, currently 278.20. If prices should fall to whatever level the medium moving average rises up to, then it will be worth reassessing the whole situation. The whole situation. As a final housekeeping point, I will retire targets X and X1 after this commentary. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.